for example, he bought a property for $300,000. He's now his own mortgage. He makes those payments back to himself. Both the asset he bought, the real estate, as well as the whole life policy would both appreciate in value. So he just turned one asset into two assets.
So let's just talk about the top deal story when it comes to commercial real estate investing and funding using your strategy. Can we start with the deal story? What was the outcome? And then we can kind of reverse engineer to how we got there. So what's the best one for one of your clients when it comes to financing commercial real estate with your strategy?
Yeah, definitely. So, just to be clear, there's many ways that you could use this. One of the most recent ways that I remember that I recently worked on, I think that was the best, was client sold one of his properties. He had about $400,000 in cash, and then he bought a single premium whole life policy. That's like a one-time payment whole life policy. It doesn't require any more payments after that. And then he instantly had about $375,000 in cash value. And he also had life insurance at this point above $580,000. So now he could essentially buy commercial real estate or residential real estate up to $375,000. And then that number keeps growing every year. So let's just say, for example, he bought a property for $300,000. He's now his own mortgage. He makes those payments back to himself. Both the asset he bought, the real estate, as well as the whole life policy would both appreciate in value. So he just turned one asset into two assets. That's one story that I've recently worked on.
Okay, make sure I unpack that. It sounds kind of cool. So he sold, had cash of $400,000. So
Yes.
he purchased a whole life insurance policy. After fees or closing costs or whatever, it's worth $375 is the cash value.
Yes.
Although the life insurance, if you were to die the next day, it would pay $875, all tax free.
Yeah.
And then that $375, he can get a loan to go buy another real estate asset or up.
Yes.
Am I following? Did I miss anything there?
Yeah. The only thing is that the death benefit was $580,000.
Oh, $580. Okay, I missed that one. Okay.
Yeah, but right, yeah, he would be able to borrow. He would be able to leverage the cash value, borrow against that, and use that to buy anything, whether it's real estate or anything else that he wants. There are no restrictions on what he could use the money for, which is a key point of this.
Okay, what are the restrictions?
There are no restrictions. He could use it for business purposes.
Oh, there are no restrictions.
Yeah, no restrictions. Yeah,
got it. Okay, so it can be business, it can be personal, doesn't really matter.
Exactly.
But you can borrow against it. And in the meantime, that cash, $375 on average, what do you think it's growing at for this particular client?
Yeah, on average over the lifetime of the policy, it's going to grow about 4 to 6%.
Okay, 4 to 6%. Got it. And then of course, what he's going to borrow at. What could he borrow at?
Sure. Would you borrow? If you're borrowing at 5% simple interest, so over like 4 years, it'll come out to about 1.9% APR. But that's how this actually works. Is that it's a good question, because the way this works is when you borrow and you're paying back, the growth of the policy outweighs what you're paying into it. So now you have this split or this arbitrage between the cost of capital and what you're earning in the policy, which is another benefit of using. Because some people ask, like, why do I have to borrow my money to use? Why can't I just withdraw it and just not pay any interest? And the reason why is because when you borrow against it, you don't interrupt the growth of it. So the growth outpaces the cost of capital to use the policy.
Cool. So let's take it on a 10-year term, right? Because you said it's compounding at 4 to 6%, right? On the 375.
Yeah.
And let's just say I borrowed 300 out, right?
Yeah.
Kept 75 in there. And you said it's 5% simple interest over like a 10-year term.
Yeah.
What's the arbitrage on average? Let's say it did 6, would the arbitrage be an extra 1, 2, 3% because it's compounding versus simple interest?
Yeah, I wish I knew this right off the top, but usually I would compare the cost of the loan as it accumulates versus the cost versus the growth of the policy. But typically, yeah, we could see that 2 to 3% arbitrage, the difference in between the cost of the loan versus how much it gained over time.
Got it. Okay, so 2-3% difference is the arbitrage, and then I wonder too. The one that comes to my mind is just inflation, right? Inflation has kind of been crazy. So I don't know what your feedback is for that. If inflation's going so far up, I guess you could make both arguments that if you're borrowing, right, you're paying back tomorrow's dollars that are inflated. So that's not bad. But if you're at 4.4 to 6, like the opportunity cost, right, of that 400,000 into something that's producing, let's say 6, 7, 8%. Plus appreciation, plus depreciation, right?
Yes.
So give us the argument or counter to that to say, I'm like, hey, I could take this 400 and put it as a down payment,
Mm-hmm.
or I could put it into the life insurance policy, borrow against it, and then put that as a down payment.
Yeah.
Am I capping if I'm only going 4 to 6 with no depreciation and no appreciation, right? It's just I'm capped out there.
Yeah.
What's the counter to that?
Well, it's like when you mentioned, when you're talking about my bio, you said, I help with not either or strategies, both and strategies. And that's what this concept is about. It's about, connecting two different assets together, or even multiple assets. So yeah, definitely. Because it makes sense, right? Like, that's a valid argument. Like, why do 4 to 6% in the whole life policy when I could do 8% or 10% somewhere else, arguably, and that's the point of this. It's not supposed to replace other investments. It's supposed to be more of a savings vehicle. I think the only thing this is really supposed to replace is a savings account and the way you finance deals. I think ultimately that's what it's meant to replace, but not meant to replace any investments. It's actually meant to enhance investments by providing you liquidity to be able to use at any time.
Cool. No, I like it. I mean, the numbers I'd really have to see like 100 unit complex purchased when somebody did this versus borrowing from Fannie Freddie at, 3% or 3.25%, and 5-year fix. I'd like to see some case studies of like someone who's done this strategy for 10 or 20 years, right? And then like a side-by-side comparison of, hey, I borrowed from the bank, or I put it into the insurance policy and I borrowed here. And then of course, let's not forget about the life payout, right, of 580. And I imagine is that growing over the time period? So,
that's also growing
in 10 years, what would the 580 life insurance payout be?
It'll probably be around 700,000
in 5 years. And then how about 10 years?
Let's see, 700,000. Probably it grows pretty exponentially. I want to say probably closer to 900,000.
Okay. Yeah, and now of course that depends on your health, right, and your age and different things like that. Correct?
Exactly. Yeah. So somebody who's 7 years old does this is going to be completely different than somebody who's 30 years old. Yeah.
Right.
That benefit is entirely based off of age and health, as well as the initial contribution amount.
Cool.